Welcome to our series on mastering the stock market. In today's video, we're diving into Chapter 2, Understanding Stock Market Mechanics. Whether you're completely new to investing or just looking to sharpen your skills, this chapter is your gateway to understanding how the stock market really works. From learning the basics of buying and selling shares, to exploring innovative technologies like algorithmic trading, we've got you covered. We'll break down key concepts like the bid-ask spread, liquidity, and risk management in simple terms with real-world examples. So, get ready to take your first step toward becoming a confident investor. Stick around as we guide you through the essentials of stock trading and help you understand how different factors influence stock prices. Let's get started. Chapter 2, Understanding Stock Market Mechanics. This chapter is specifically designed for individuals new to the stock market. It provides a clear and comprehensive understanding of how the stock market uses simple language, practical examples, and helpful visuals. Overview of stock market mechanics. The stock market facilitates buying and selling shares of publicly traded companies. Owning shares represents partial company ownership. This chapter explains the process, key players, and factors influencing stock prices. Basics of trading: buying and selling shares. Companies list shares on exchanges like the New York Stock Exchange, NYSE, and NASDAQ, which connect buyers and sellers. NYSE, traditional exchange, often listing larger, established companies. For example, Coca-Cola, Johnson & Johnson. NASDAQ, electronic exchange, known for listing technology-focused companies. For example, Apple, Microsoft, Tesla. Clarifying key concepts. Bid-ask spread. The difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask. A narrower spread often indicates higher liquidity. Liquidity refers to how easily an asset can be bought or sold in the market without affecting its price. High liquidity means transactions can occur quickly with minimal price impact. Real-world example: IPOs and capital raising. Consider a recent IPO like Airbnb's. The company listed its shares on NASDAQ to raise capital, allowing investors to buy shares and provide funds for expansion. Exchanges facilitate this process by providing a platform for trading these new shares. For example, a chart showing different spreads for high liquidity stocks versus low liquidity stocks can highlight cost implications for traders. How technology has transformed trading. Technology has revolutionized stock trading, creating a more accessible, faster, and data-driven environment. 1. Evolution of trading platforms. From physical trading floors to online platforms and mobile apps, accessibility has increased significantly, allowing retail investors to trade from anywhere at any time. 2. Algorithmic trading strategies. Trend following. Algorithms identify and capitalize on established price trends. For example, an algorithm might automatically buy a stock if its price consistently rises above a certain moving average. Arbitrage. Algorithms exploit price differences between markets or exchanges. If a stock trades for $10 on one exchange and $10.05 on another, an arbitrage algorithm could buy on the cheaper exchange and sell on the more expensive one, profiting from the difference. Mean reversion. Algorithms bet on prices reverting to their historical average. If a stock price deviates significantly from its average, a mean reversion algorithm might bet that it will return to the average. 3. AI-powered sentiment analysis. AI analyzes news, social media, and other data to gauge market sentiment and predict price movements. For instance, AI could scan social media to assess public opinion on a company's new product launch, using sentiment trends to predict stock price changes. 4. Mobile trading apps. Apps like Robinhood, Fidelity, Schwab, and E-Trade offer users easy access to the markets, lowering the entry barrier for new investors by offering commission-free trades and educational resources. Types of orders. Instructing your broker. The sources provide a list of 4 order types. Market orders. Buy/sell at the current market price immediately. Limit orders. Buy/sell at a specific price or better. Stop orders. Stop-loss orders. Sell when the price drops to a certain level. Stop limit orders. Combine stop and limit orders. Market makers. Providing liquidity. Market makers ensure continuous trading by always being available to buy or sell shares, providing liquidity to the market, and facilitating smoother price movements. Placing a trade. Understanding the bid-ask spread. Bid price. Highest buying price offered. Ask price. Lowest selling price offered. Bid-ask spread. The difference between the ask and bid prices is often wider in less liquid markets. Real-world examples of market dynamics. High liquidity. Apple, Microsoft. Highly liquid stocks are easy to buy and sell without significantly affecting the price. Low liquidity. Penny stocks. Stocks with low liquidity are harder to trade and have wider spreads, increasing potential price volatility. Impact of news events. For example, a natural disaster affecting a company's operations may cause its stock price to fall, while geopolitical instability can trigger market-wide volatility. Company-specific case studies. Positive earnings announcements typically boost stock prices, while negative events, like product recalls, cause declines. The dot-com bubble serves as a classic example of inflated market sentiment, driving prices unsustainably high, followed by a severe crash. Historical context. Global events and U.S. trading hours. Over time, global events like economic crises or technological advancements have influenced U.S. trading hours. For instance, the 2008 financial crisis led to increased volatility and changes in trading regulations. Market volatility and risk management. Stock prices are subject to volatility, and effective risk management is crucial for successful investing. Types of risk. Market risk. General market downturns affecting all stocks. Company-specific risk. Risks unique to a company's performance or business. Liquidity risk. Difficulty in buying or selling a stock without moving the price. Interest rate risk. Rising interest rates can reduce investment values. Inflation risk. Erosion of purchasing power over time because of inflation. 2. Risk management strategies. Diversification. Spreading investments across different asset classes to reduce exposure to any single risk. Stop-loss orders. Protect against significant losses by selling a stock at a predetermined level. For example, Buying a stock at $50 and setting a stop loss at $45 limits the loss to $5 per share. Hedging with options. Using options contracts, such as purchasing puts, to offset potential losses in an investment portfolio. 3. Risk tolerance and investment goals. Example question: how comfortable are you with the possibility of losing 10% of your investment over a short period? Align risk tolerance with personal investment goals, where long-term investors might tolerate higher risk, while short-term goals might require a more conservative approach. Addressing common misconceptions. Misconception: all stocks are highly liquid. Explanation: liquidity varies. Not all stocks can be easily traded without affecting their price. Misconception: wider bid-ask spreads always mean higher costs. Explanation: while generally true, some traders may benefit from wider spreads if they manage timing effectively. Algorithmic trading in modern markets. Algorithmic trading uses computer programs to execute trades at high speeds based on preset criteria. It plays a significant role in modern markets by increasing efficiency and liquidity, but also raises concerns about volatility during rapid market movements. Psychological factors in market decisions. Psychological factors like fear and greed can significantly impact market decisions. For instance, during market downturns, fear might lead investors to sell prematurely, while greed during bull markets might cause overinvestment. Market regulation and investor protection. The SEC's role. The Securities and Exchange Commission, SEC, protects investors, maintains market integrity, and enforces regulations such as insider trading prohibitions, preventing unfair advantages based on non-public information, disclosure requirements, mandating transparent reporting by public companies, best execution practices, ensuring brokers execute trades at the best possible prices, investor protection resources. SEC's Investor.gov, a comprehensive resource with fraud prevention tips and detailed guides on investing basics. FINRA, the Financial Industry Regulatory Authority, offers educational content and tools for evaluating brokers. Conclusion: this chapter aims to provide beginners with a robust foundation in understanding stock market mechanics, while engaging them through interactive elements and real-world examples. While investing inherently involves risks, it is important to conduct thorough research, assess personal risk tolerance, and make informed decisions based on your financial goals. Thanks for watching Strategic Signal. I hope you found this video insightful and helpful as you continue your journey in mastering the stock market. Before you go, don't forget to hit that subscribe button and tap the notification bell so you don't miss any of our upcoming videos. Trust me, you won't want to miss what's coming next as we dive deeper into the world of investing and unlock even more strategies to help you succeed in the markets. Also, we've packed the video description with questions and answers that might help clarify some concepts we discussed today. So, be sure to check that out. And now, I'd love to hear from you. What did you think about this chapter? If you have any questions or thoughts, feel free to drop them in the comments section below. I'll be checking and responding to as many as I can. Thanks again for tuning in, and I'll see you in the next chapter.